Hey everyone, welcome to our Asset Management Friday segment of the Passive Income Through Multifamily Real Estate podcast. I'm your co-host Kyle Mitchell, also joined by Gary Lipsky. This segment is focused on educating operators, building better systems, and becoming a best-in-class operator. Also, be sure to check out our Facebook group, Passive Income Through Multifamily Real Estate. All right, today on the show, we have Ellie Perlman. How you doing, Ellie?
I'm doing great, Kyle. How are you?
I'm doing great. Thanks for coming on. If you can start by telling the listeners a little bit more about yourself and what you currently do.
Yes, so I can start with what I currently do. I think that's more interesting, which is multifamily. So I buy large multifamily properties, usually 200 to 500 units in interesting growing markets like Georgia, Texas, Florida, the Carolinas. And a little bit about my background. So I've been in real estate for over a decade now. I started as a real estate lawyer back in 2007. Witnessed the crash with my clients, so I learned what not to do, during a financial crisis and how to be very conservative. Then, after working as a lawyer, I was asset manager / property manager, and then all of that was actually in Israel. Then I moved to the States. I went to MIT. I got an MBA degree, and shortly after I started, after graduation, I started Blue Lake and started buying multifamily properties, and that's what I do today.
Well, thanks for joining us. I know you just recently closed a deal dealing with pref equity, so let's talk about that today. So, what exactly is pref equity, and when would you use it?
Absolutely. So, pref equity is it's a source of equity from a large group. It can be anywhere between $5-6 million all the way to $20, $25, $30 million. It's usually coming from certain groups that are interested in the asset, and they like to write larger checks because they don't want to invest in 5-6 different assets every month. They like to pick specific assets. And when you think about it, we know what debt is. Obviously, you go to a lender and you get a loan, and you have equity, which is, investors. Normally, pref equity sits somewhere in between debt and equity. So it's a large check, kind of similar like a lender that's going to write you a large check. And usually they're getting paid before your investors get paid. So again, it looks, the group behaves like a lender, but they're not a lender. So they're getting paid after you pay your lender. Let's say it's a Freddie Mac loan. You pay your lender. Then if there's any money left, you pay the pref equity group, then investors, and then you. That's usually, this is usually how you work through the cash flow. And normally, and listen, there's a lot of groups out there, and every pref equity group has its own structure, but many groups say, okay, we're going to write you a certain check. I think the minimum, many groups work with a minimum of $9 or $10 million. We want X amount, return every month or every quarter, every year. So they set up a certain, it can be 5%, 7%. And in that sense, again, they look more like a lender because they get a certain amount of the cash flow. They don't participate on the back end. So they don't get anything when you sell the property. What you need to do is make sure that you have enough money to pay them their minimum returns, every month or every quarter, whatever the arrangement is, usually monthly.
And have you gotten pushback from your regular investors because now they're in almost like third position, basically, after the lender and the pref equity? And if so, how have you been able to combat that?
Yeah, so not really, because in a sense, it's like a lender. So normally a deal works with pref equity group if you're trying to get to a certain LTV. So let's say you want to get to a 75% LTV, but the lenders want to give you only 70% LTV. Then the gap, you just go to the pref equity group and you bring the funds. This is just an example. So in a way, it doesn't really matter because it's as if they're two different lenders and you're paying, the lender before you pay them. But also I think it's an interesting question. This is where conservative underwriting is, very relevant, because you say, hey, right now, if I run the numbers, there's enough money to pay the lenders, the lender, the pref equity group, and investors. And we're assuming that we're not even raising rent in the first 12 months of operations. But if you're actually planning to raise rents and start renovating, and that helps, that puts investors at ease, because they know, okay, even in the worst case scenario underwriting, I'm still getting paid. Then I believe that this group that I'm investing with can actually, overperform, because the underwriting is very conservative. And that kind of, that makes them feel a little bit more comfortable. But it's not extremely different. There is a difference, but it's not very, very different than having basically a lender in pref equity group, and you basically treat them like one lender that needs to get paid, before investors get paid. And remember, as sponsors, we get paid last. We're in the very, bottom of, the list. So we are even more incentivized to work even harder to make sure that by the time our turn, by the time it's our turn to get paid, that there's actually going to be enough money for us, to pay ourselves. So.
Yeah, you don't have to remind Kyle and I about that. Absolutely. This is a performance-based role that we're in, and I'm all for it. I mean, I'm a big sports guy, and I'm all for like performance-based, pay. But tell us something about the pros and cons of using pref equity.
So I think I'm going to start with the cons, because I want to end up on a high note. Obviously you have another group that is doing a very, very thorough due diligence on you as a sponsor, on the assets. They're touring the assets that you're managing so far. They're going to tour the asset that you're asking them to investing or join. So the legal costs are almost double, because it's as if you're hiring your lawyers to negotiate with another lender. It's, you have another term sheet, you have another, agreement. And normally the pref equity group is going to require you to give them, some guarantees, because unlike Freddie, yes, it's a non-recourse loan, because they have the asset. If you don't pay, they can go to the asset and sell it. Pref equity groups don't have it, because they're not lenders. So there's no lien on the property that secures their debt. It's basically your good name, your reputation, your track record. So they put a lot of emphasis into really looking into who you are. And in that sense, actually, some of my investors liked it, because they said, oh, if a large group did all the work to research the property, the team, and they think it's a good deal, then me, without all the resources, I feel more comfortable to invest. It's like an angel investor that invests, here and there, just a one-man show kind of, a single investor. And I'm an angel investor too. When I see startups that are backed by large VCs, I know that, okay, I have resources, but I won't have this billion-dollar, company's resources. If they've done the work and they've invested, then I feel more comfortable. And it's kind of the same here. So these are the cons, just, more negotiations. You need to provide some securities. So they're looking more into your financials and your track record, and they're doing a even more thorough due diligence than the lender. The pros is that you can actually do larger deals, because that instead of raising $10 million extra, you can work with a group and they'll basically provide this financing too. It's if your lender, your servicer is actually bringing the group to the table, it's extremely helpful, because they know you and they know them, and they're mediating, they're sitting very, very close to the deal so they can talk about the deal. They can talk about their experience working with you as a sponsor. That's another pro that definitely helps. And, I think just generally speaking, it just opens the door to, it's kind of a step up in your game as a syndicator. Now you're doing much larger deals. And once one group is interested and invested with you, you kind of open up the door to keep doing those large deals and keep either working with the same, sponsor, because they've done all the same pref equity group, because they've done all the research, they're more likely to invest with you again. And then other groups are looking into your deals and looking into you as a sponsor that, can bring them more deals. So it definitely helps with scaling and doing larger deals, more doors. It's almost the same amount of work with the exception of raising, more money, but anything other than that is pretty much the same.
Great advice. Do you have things a new syndicator should look out for when dealing with pref equity?
New syndicators will find it very challenging.
Syndicator, but doing your first pref equity deal.
Yes. Things that they should be looking for.
Yeah.
I think my number one advice is if you're working with a lender, with a servicer, just have them bring you, just ask them, do you work with pref equity groups? It's going to be a lot easier. We're working with Northmark, for instance. It's a lot easier when they bring you the deal because they already have those relationships, and it's going to save some time on negotiation also. And they can match the right group to you because they know you, especially if you've done a few deals with them. It helps with building the relationships because they can talk about who you are as a sponsor. And many of them you don't know, but many of them, Northmark, but also CBRE and, a lot of other large servicers, they're actually, and brokers, they actually have those relationships and they match between those groups. So I think that would be, if I wanted to start, I would start there. They're more likely to look at a deal that you have if, let's say, Northmark or another servicer is going to present it to them, than you just reaching out, doing a cold call, sending out an email. They get those emails all the time. But when the same, financial institution that has been extending loans to them in the past is telling them, hey, we're working with a client of ours. They're looking to, place $10 million. I think it could be a good fit. We've worked with them before. They've performed very well, especially during COVID. Would you like to look at this deal? It's just a different conversation.
Yeah, that's really good advice. So obviously, when you're moving up the food chain, working with pref equity, there, the loan is bigger. You're dealing with higher requirements for net worth and liquidity. Does the pref equity partner help out with that, or if not, like how are you solving that issue?
That's a good question. I don't know because we didn't use them for our net worth and liquidity. Maybe, everything is possible. I think if you compensate someone well enough, they might do it. I don't know if that's what they're used to do, or if it's an option. But I think, if you compensate someone, a group, then perhaps.
Right.
It's not a bad idea. I didn't think about it before. It's not a bad idea.
And would you use pref equity again?
Probably. It's a lot of work. I got to say, even after closing, there are a lot more reporting that they require compared to Freddie. So for instance, Freddie or Fannie Mae, Freddie Mac, once a quarter, you need to send them the T12, certified T12 and rent roll. And if you took a loan for the CapEx, then there's, some Excel spreadsheets you need to send them with description of the work that was done, how much it cost you, and a copy of the receipts. And that's about it. When it comes to pref equity, you have a lot more, that could be a monthly, you need to send the reports on a monthly basis. You need to send bank statements and, the reporting is deeper because again, they don't have the property, they don't have any lien on the property, so they're basically, it's kind of, the debt is not that secure, so they need more layers of scrutiny. And I also think once they've worked with the syndicator and you've paid them on time, then the next time it's going to be easier, and then maybe they don't need to see the T12 every month. Once a quarter is enough. But especially when you're starting out, there's like there's more scrutiny and reporting that is required. So just make sure if you do it that you have the bandwidth to do it, and if not, hire people that can help you submit all those reports, because you don't want to miss your reports. So we have an asset management team, but we also have on my calendar reminders 10 days before the deadline, so I can start seeing if they're even working on it, because I don't want to be late. It's everything has to be on time.
Yeah.
I'm going to pass it over to Kyle to take us home.
All right, Ellie, what is your asset management superpower?
I like details. From my past life as a lawyer, I used to read 100, 200 page contracts. So, and finding what section is not working with another section 50 pages earlier. So I would say attention to detail is that's pretty key when it comes to asset management. And also I think project management skills, just to know who needs to do what, and making sure that you see the picture, from that you actually see everything, and it's very granular. So this is how much I need to increase the NOI starting at month 13. So in month 24, I can match the cash on cash to year 1 to year 2 projections. So it starts way ahead of it. And then every line item, what can I do to drive NOI? So that level of granularity, that's what I enjoy doing.
Awesome. Love that. All right. Well, Ellie, we appreciate you coming on the show and talking to us about preferred equity. Can you tell the listeners where they can find out more about you?
Yes, actually, it's pretty easy. You Google Ellie Perlman, or just type ellieperlman.com and you'll see my website.
Perfect. Everyone listening in, thank you for tuning into this episode. If you like this episode, please give us a like, subscribe, and review on iTunes or Stitcher so we continue to grow this audience, and we'll talk to you next week. Hey, everyone. Thanks again for tuning in. We really appreciate your support. If you're interested in learning more about APT Capital Group and speaking to someone on our team, click on the link and schedule a call with us. We're here to help, and we'd be excited to speak with you and get to know more about you and your goals. Talk to you soon.